Hello and welcome to The Print. I'm TCA Sharad Raghavan, Deputy Editor, and I'm going to be talking to you about the trouble that's brewing at the bottom of India's economic pyramid, in particular to do with credit card loans. Credit card defaults rose significantly in the April-June 2024 quarter, especially amongst the credit cards with low credit limits, according to new data from two credit bureaus. This was driven by a sharp increase last year in the number of credit cards issued and low income customers using these cards to spend beyond their means, according to banking analysts and economists. Notably, the data shows that as of June 2024, payments amounting to one-third of the credit card dues for credit cards with a limit up to 25,000 had been defaulted upon for more than 90 days. This ratio was one-fifth for cards with a limit of 25,000 to 50,000 a month. Basically, the biggest jump in defaults were amongst the cards with the low credit limits. However, analysts did add that the regulators have taken timely steps over the last year to curb not only the growth in credit card issuances, but also to curtail avenues for such excessive spending. According to data from CRIF Highmark, a prominent credit bureau operating in India, the share of the credit card PAR 91 to 180, which is a measure of loans defaulted on for over 90 days and less than 180 days, rose to 7.6% in the quarter ended June 2024, from 6.5% in the June 2023 quarter and 6.1% in the June 2022 quarter. The proportion of PAR 180 to 360, which is the share of the outstanding amount that had been defaulted on for 181 to 360 days, rose to 0.9% in the June 2024 quarter from 0.7% in the same quarter of the previous year. Data from TransUnion CIBIL, which is another credit bureau, also showed that the PAR 90 plus level stood at 1.8% as of June 2024, up from 1.6% in the June 2023 quarter. Now, according to analysts and economists in the financial services industry, there were two main reasons for the increase in credit card defaults. The first driving force was the sharp increase in the number of credit cards last year and the dilution of scrutiny by card issuers when giving cards to low-income customers. Intertwined with this is the second driver, the trend of low-income customers using credit cards to fund non-essential and conspicuous purchases, which they ordinarily would not have been able to afford. The economists The Print spoke to said that what happened is that in 2023, as part of the post-COVID boom, the markets were picking up and people had this general thought process that the economy was going to pick up and the boom would continue. As a result, people started taking aggressive positions in the stock market and also started taking a lot of interest in the futures and options segment. They added that when there is an expectation that incomes from other sources, such as from the capital markets, will increase, then people take credit cards and start spending beyond their means, expecting that the cash flows from these other sources will continue. However, that didn't turn out as planned. The markets didn't perform in the ways people expected them to, and people were not able to sustainably service the credit card spends that had already happened. People prioritized the payments they did want to make, and the easiest thing to defer were credit card payments. Things like rent, salaries, and household expenditures are much more urgent, so credit card payments suffered. India's tryst with the futures and options market has been extensively documented by The Print, with reports on the surge in F&O activity in India, how most of the people losing money in this segment are low income, small town, and young, and how SEBI eventually took steps to curb the participation of these low income traders in this segment. In keeping with these findings, the data from CRIF Highmark showed that the biggest jump in the default ratios was seen in the cards with monthly credit limits up to 25,000 and 50,000. The PAR 91 to 180 ratio for credit cards with a limit of rupees 25,000 a month jumped from 24.3% in the June 2023 quarter to 29.8% in the June 2024 quarter. So that's nearly one third. For the cards with limits between rupees 25,000 to 50,000, this ratio increased from 16.7% to 20.6% over this period, to one-fifth. The people with the lower credit limits are typically the ones with lower incomes, who may not have qualified for a credit card under normal conditions, banking experts told ThePrint. But there could have been situations where these norms were flouted because the customers said that they were getting some other income, they added. Additionally, these experts pointed out that low value customers who are given a credit limit of rupees 50,000 or so will typically max out their cards each month. That is, they'll spend the entire credit limit. You'll see a lot of their credit card spending being concentrated in non-essential or ostentatious purchases such as a car, a phone, an electronic item, or the stock market and F&O segment. Now, while the situation definitely has worsened as of the June 2024 quarter, experts feel that things will likely improve over the next few quarters as the effects of steps taken by the RBI and SEBI come into play. The RBI had been warning banks about the sharp growth in unsecured loans through the bulk of 2023 until in November that year, it finally took action. Through a notification, the central bank increased the risk weights for unsecured loans given by banks and non-banking financial companies. This move, in essence, made it more expensive for the lenders to give out such loans and more expensive for the borrowers to avail of them. SEBI also took steps to curb the excessive trading in the F&O segment by increasing the minimum contract size that could be bought, effectively putting them out of reach for low-income traders, and reducing the number of weekly opportunities to trade in this segment, amongst other technical changes. But all of this protects the financial system from future defaults. What it doesn't do is address the issue of people's incomes not rising fast enough to keep up with their aspirations. But on that note, that's all from me. Thank you for watching.